which means the cash paid or cash to be paid will be the 30,500 minus the discount, which is 610. I will get a total of 29,890. So now the liability balance is 30,500, and I will pay cash. We said cash is 29,890, and finally we will have a discount, and this discount has an amount of 610, so we have to put 610 on credit to balance, and I will credit for this inventory. Why we credited inventory here? Because simply we credited inventory because the value of inventory is not really 30,500 that we have on hand. The value of inventory that we have on hand is only 29,890. That's why we decreased the amount of inventory by 610. So based on the perpetual inventory system, I will debit inventory for the purchase. I will debit the inventory for the purchase price. I debit the inventory for any freight paid on this purchase. I will credit inventory for any purchase returns, and I will credit inventory for any purchase discount. So this is the this is what we call it a perpetual inventory system. So we call it a perpetual inventory system because it keeps an updated record of inventory and cost of goods sold, as we will see in example 2 or exercise 2. Okay, in exercise 2 also we will use now in exercise 2 I will use for the same transaction, July 6, July 7, July 8, and July 15. I will use for the same transaction. Now I will use a different system called periodic inventory system. How the accounting treatment will be different this time. So now we made a purchase, so we will not use. You will never see inventory account in a periodic inventory during the year. So the journal entries that we will do during the year will not include inventory. So only inventory will appear, or like we will account for it by the end of the period. But during the period for purchases and sales, we will not change the amount of inventory. We will use some temporary account. For example, I will use purchases instead of inventory. So I will debit purchases by 30,000, and I will credit okay, and I will credit accounts payable by 30,000. Now the second one is July 7. July 7 paid $1,500 cash as a freight on July 6 purchases. So this is, we will call it freight in, and we will credit cash. So as you can see, we have two types of freight: freight in and freight out. Freight in, the freight that we pay to get the inventory in our stores. Freight out is the freight paid to get inventory out of our stores, which means when we sell it. But the freight in, when we buy it or purchase it. So I will debit this by, as you can see, 1,500, and I will credit this one by 1,500. Now the third transaction is related to purchase returns. So we made a purchase return of 2,500. So in this one, I will debit accounts payable, and I will credit, instead of inventory, I will credit purchase return. With an amount of 2,500, and for this one 2,500. Finally, for the payment, I will debit accounts payable, and I will credit purchase discounts and cash. So accounts payable will be debited by 30,500, and purchase discounts will be 610, and finally cash will be 29,890. Please, now I will give you just some time. Now just pause the video and try to compare the solution that we have for this transaction under the periodic inventory system and the solution for the same transaction under the perpetual inventory system. Okay, now I will assume that you just made a comparison between the two. As you can see, in the periodic inventory system, inventory increased by the any purchase, increased by the freight that we paid on purchases, decreased by the purchase returns, and decreased by any purchase discount. In a periodic inventory system, that will not happen. We will use different accounts to account for inventory. So we will use purchases for purchase, the freight account for the freight, and purchase return account for the purchase return transactions, and purchase discounts for any purchase discounts paid that we got. Sorry. Now, by the end of the year, these accounts, purchases, purchase discounts, and purchase returns, will be closed, and to get the figures that we talked about, the ending inventory and the cost of goods sold. We will talk about this later when we talk about the cost flow methods. So now this is how to account for purchases of inventory under periodic and perpetual